So a lot of progressives, like me, were quite frustrated when corporate Democrats decided to side with the Republicans in order to deregulate the banks. Now, of course, the criticism here is it's going to help the big banks. It's going to help the big banks if you roll back these certain regulations, and I'll explain what they are in a minute. But what happened? They passed a bill, and of course, it helped the big banks. Turns out, wow, that's weird how that works out. It turns out we were right. But that's the thing. It helped the banks because that was the entire point of the banks. Now, of course, when it was being debated, this is the Crapo Bill, Crapo Bill, whatever you want to call it. I think it's a Crapo Bill. Corporate Democrats said, no. What this is going to help the small banks. We're not trying to help the big banks. We're trying to help the small community banks and credit unions. That's exactly who we're going to help. Now, one of those Democrats is Sean Patrick Maloney. And he's a House Democrat who's from New York, who's running for both re-election. And as Attorney General of New York, this is supposed to be the Sheriff of Wall Street position. Fascinating. Now, he voted yes on deregulating the banks. I thought if you're supposed to be Sheriff of Wall Street, you're supposed to be tough on the banks. Well, it turns out Mr. Maloney, not so tough on the banks. But of course, he tries to rectify that by saying, no, I didn't pass it. I passed it because I didn't want to hurt the little banks. I don't want to hurt the little banks. He says, if you look at the African American Credit Union Association and the African American small bankers, those are the guys who benefit from the easing of some of these restrictions. So we got to protect the small guys, the medium guys. I mean, look, this doesn't help the big banks at all. In fact, it doesn't help them at all. Okay, well, let's see if that's true, right? According to The Intercept, a letter sent by 7 Senate Republicans last week suggested that the law is trying to do precisely what its critics warned that it was going to happen, provide regulatory relief for some of the largest banks in the country. David Dayen writes, the letter headlined by Senate Banking Committee member David Perdue is a classic Washington document, signed by members of Congress but transparently prepared by lobbying groups looking to add congressional backing for their priorities. While the bill's author, Senate Banking Committee Chair Mike Crapo, isn't on the letter, that's likely because it would be messy to have the senator promise Democrats in negotiations that big banks wouldn't benefit from the legislation turn around and assist the lobbying efforts of those very same institutions. So I love how they point that out, right? That's probably one of the most important pieces of this story. It turns out that just like so many bills and pieces of legislation and letters on behalf of industry by politicians are actually written by the industry and the lobbyists. Weird. Funny how that works out. It looks like the corruption is in your face. That's what it is. Dan continues. The shadow authors of the letter represent banks holding between $100 billion and $250 billion in U.S. assets. Now, it turns out that 25 of the 38 largest U.S. banks, a gigantic majority, fall into this category. They have become known on Capitol Hill as stadium banks because they're not quite big enough to be called a mega bank, but big enough to buy the naming rights to a stadium. So that is quite clearly a literal definition of a stadium bank. I can go and buy this Fifth Third Stadium. Great example of that. Now the stadium banks, and again, I've seen that stadium. That stadium exists. Bank of America Stadium. I don't know if that actually exists. Probably does somewhere. But the stadium banks, which include U.S. subsidiaries of foreign-run banks, want to make sure the Federal Reserve wipes out all enhanced regulatory standards established in Dodd-Frank for firms of their size. The bank deregulation law allowed for such a circumstance, with Senate 17 Democratic caucus members and 33 House Democrats signing on. Now Senate Republicans want to encourage the Fed to finish what Congress started. So I mentioned 17 Senate Democrats. You have people like Joe Manchin signing on to that, but also people like Tom Carper and Sean Patrick Maloney. Now, Sean Patrick Maloney and Tom Carper are running for re-election. Now, Manchin also running for re-election, but he's not going to have the type of pushback that Tom Carper or Maloney is going to have for working with Republicans to deregulate the banks. Turns out, deregulating the banks is actually really unpopular. I know, weird. Helping Wall Street, pretty unpopular. Again, weird. So now, Carper, for example, has already faced questions this election season about why he supported dismantling Wall Street protections and has cited his support of community banks as his motivation. Carper told The Intercept while the Senate was deliberating on that bill, among the people that have pushed hardest for me to support the legislation are, believe it or not, credit unions and community banks. But that is not the reality. This legislation is actually in favor of these stadium banks, these enormous banks. In fact, under the Crapo Bill, the threshold for enhanced regulatory standards was lifted immediately for banks between 50 billion and 100 billion in assets. Yes, that is, of course, considered smaller banks, and within 18 months for banks up to $250 billion. These enhanced regulations included extra capital and liquidity requirements, stress tests, and souped-up risk management. Most experts saw this as the part of the legislation that would have the most impact. So these stress tests and things like that, turns out these banks didn't like that. They didn't like having these liquidity requirements because what they wanted to do is that, like any corporation, they want to maximize profit. So they, of course, will make risky, ventures, risky loans, and things like that, financial speculation. And if they lose on that, well, they could go under. If they go under, you could have another chain of banks going under because they all seem to be interested in doing the same thing, maximizing profit. Now, the Crapo Bill, however, did provide a safety valve, giving discretion to the Federal Reserve to reapply certain enhanced standards to banks between $100 billion and $250 billion if they found them to create systemic risk. Oh, see, not going to happen again. That situation that you just said, Jeff, that's not going to happen because we've got a safety valve in here. Under the discretion of the Federal Reserve. It's fine. See, we can lose the rest of those regulations. In fact, Randall Quarles, the Fed's vice chair for financial supervision, addressed this back in July at a conference of the American Bankers Association. He said, Dan writes, while Quarles stated the capital and liquidity requirements should remain for these firms, those requirements should be less stringent, along with less frequent stress tests and no living wills requirement for mapping out how to unwind the firms if they get into trouble. Quarles added that even less complex and interconnected firms above the $250 billion threshold could get some requirement eased as the legislation allows. So this is the Fed's vice chair for financial supervision saying, yes, let's do a little bit of deregulation. Let's not deregulate it completely, but a little bit of deregulation so the banks don't have so many stress tests or requirements so they can unleash their capital, right? Now, Dan writes that the speech was broadly in line with the deregulatory bent of removing rules for the largest U.S. banks. Now, is that going to be enough? Is that going to be enough for Republicans and for these lobbyists and for these corporate Democrats? Well, let's get into that. Now, Dan writes that the fact that Quarles didn't immediately endorse removing all enhanced standards panicked bank lobbyists who immediately ran to their allies in Congress to impress their views upon the Fed. Perdue and his 6 Senate Republican co-signers wrote Quarles on August 17th, a couple of days ago, quote, it is the understanding of my colleagues and me that S-2155, the Crapo Bill, shifted the assumption that financial companies with less than $250 billion are not systemically risky. This section also allows the Fed to adequately tailor regulations beyond the $250 billion asset threshold because companies do not suddenly become systemically risky when they cross an arbitrary asset threshold. Basically, what they're saying is, we should just get rid of all the regulations. because they're not systemically risky. I mean, you just made an argument for a little bit of deregulation, and we're just saying we're going to use that argument to go for full deregulation. Now, as Dan points out here in the article, that whole idea that these banks under $250 billion are not systemically risky is a contested claim. And he gives an example here. Several financial firms in the $100 billion to $250 billion range were actually critical to the subprime crash, and it turns out were bailed out by the United States government, or I should say, by the taxpayers, you and me. We bailed out those banks. Now, these banks included National City, GMAC, and Countrywide. Going back further, if you adjusted continental Illinois size for inflation, when it received a federal bailout in 1984, it would fall into the $100 billion to $250 billion range. So the whole idea that range of money, assets in the bank, $100 to $250 billion, is not systemically risky, could never lead to a crash, is ridiculous, as we have examples, specific examples from the financial crisis in 2008 that shows that they are indeed systemically risky or can bring down an entire crash. It could bring down the economy. Nonetheless, Perdue and his colleagues are not only asking for the elimination of all enhanced regulations below $250 billion, but even for help to those banks that have more than that amount of assets. Kind of seems like this bill was supposed to help big banks. Sure, it also helps medium-sized banks, but it also helps the big banks, because that was the whole purpose. In fact, Senate Republicans want Federal Reserve administered tests completely eliminated for banks under $250 billion, as well as the main liquidity rule that ensures banks have enough cash to operate under a hazardous scenario. They also repeatedly indicate that they don't see arbitrary asset thresholds as sound, urging the Fed to lighten the rules above that threshold as well. And finally, it asks, the letter does, and therefore these Republican senators, they ask that foreign banks' U.S. operations receive comparable regulatory treatment to U.S. banks of the same size. Now, that would essentially have these foreign banks that operate in the United States have looser regulations than they would when they were operating in Europe or wherever they're from. I give Europe as an example because in some places in Europe, they actually do have better regulation of their financial sector. Well, of course, opponents of the bill warn that practically all foreign bank subsidiaries, everyone but HSBC, has less than $250 billion in assets, would get their regulatory standards loosened. Bill supporters like John Tester, Democrat from Montana, called this, quote, a myth. But his fellow supporters on the Republican side want to turn that so-called myth into reality. So now you have this deregulation bill that could make the reality of another financial crisis more likely. You have Democrats defending this. You have John Tester. I wouldn't be surprised if Joe Donnelly, who probably also signed on to this, Joe Manchin, Sean Patrick Maloney, all these 17 Democrats defending this bill. Why would they do that? Well, it's because, look, you got to follow the money. Big banks, turns out, give to both Republicans and Democrats. I know. It's funny, Barney Frank, when asked, should we take no big bank money instead of the 20% that we get already? Yes, we should. We should. We should totally not take money from big banks. What they do is basically, look, 80% of that money goes to Republicans, right? Because Republicans will do the bidding of Wall Street and corporations. There's no doubt about that. We know that already. That 20%, it doesn't necessarily amount to a whole lot of money. But what it does is that it buys compliance. It tells these corporate Democrats, no, you're going to let Republicans do whatever they want. You're going to let Republicans deregulate our industry. You're going to let Republicans, lower our taxes. You're going to let Republicans get away with everything. And then your job, after you lose, is to come back to the American people and say, what can I do? The Republicans were in charge. That's what's going on here. Now, of course, some of you might be asking, why do you hate the banks so much, Jeff? Why? Well, let me go to a quote here from Dan. He said, lifting regulatory standards on some of the biggest banks in the world, which happen to have giant rap sheets full of alleged misconduct, like foreign exchange and interest rate manipulation, that's the LIBOR scandal, money laundering, Deutsche Bank, tax evasion, again, Deutsche Bank, transactions with sanctioned countries, for the third time, Deutsche Bank, mortgage fraud, Bank of America, and illegal repossessions from active duty service members would further weaken the claims that the Crapo Bill only affected small banks rather than bestowing gifts on undeserving behemoths. So why am I hating on the banks? Because they basically run the place. They get tax cuts, they get deregulation, they pay off our politicians on both sides in order to screw the American people. And look, I don't hate banking as a function. Banks are important. But the problem is that they're not doing what they're supposed to be doing anymore. See, banks have basically turned into profit-making ventures instead of a secure place to store your money or to get fair loans. Now we have predatory loans. Now we have predatory capitalism. I hate that many of them get away with stealing from average Americans with fees and penalties that punish the poor. The one agency that we had, the Consumer Financial Protection Bureau, has decided not to punish some of these banks. Have decided, you know what? No, we're going to let these guys go. Payday lenders, same thing, right? It's the corruption. I hate the corruption, and the corruption is happening in Wall Street. That's why we have to regulate them. That's why we have to break them up. A bank cannot be too big to fail. That should not be a thing. If you're a conservative, if you're an actual conservative, you should believe in, hey, you know what? Competition, free markets, not picking winners and losers. What do you think too big to fail actually means? It means we're picking a winner. Break them up. You got to break them up, or we're going to see another financial disaster. And by all rights, with Donald Trump in charge and the Republicans, it's going to be far worse than what we experienced at the end of the Bush administration and into the Obama administration. Hey everybody, thanks for watching this video. If you want to see more like this, please hit the subscribe button below. And if you want to support truly independent progressive media, please consider becoming a patron at patreon.com/TYTNation.